The S&P 500 fell about 1.5% today, just in front of President Biden's State of the Union address here tonight. The reason that the market was down today largely revolved around what's going on with Russia, Ukraine. We saw commodity prices flying higher once again. We also saw something new that we hadn't been recognizing in recent weeks, which is interest rates have really started to take a tumble in the last couple of trading sessions, and that started to really negatively impact a number of financial stocks. So we're going to take a look at all of that, see what it means for our posture, and then I wanted to get into a trade application example where I wanted to determine if babies were being thrown out with the bathwater in the financial sector, and I wanted to show you how to sell a put on one of my favorite banks. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 1st, 2022. First of all, if you're new, welcome aboard. Remember to head on over to YouTube, click subscribe on our channel, then make sure you're signed up for our email distribution list, which you can find in the description below the video. We're also heavy users of Twitter. I'd encourage you to follow me at Brandon Van Zee if you haven't done so already. We really appreciate those of you that click like and retweet on these market outlook related posts. And then last but not least, we do have a group over at Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And once again, as you can see here with the S&P 500 heat map, it was a sea of red. Vast majority of companies closing lower on Wall Street here today. Of particular note is this section in the upper right. Notice how bright the red is with those particular squares and rectangles that you see. A reminder that the brighter the red that they are, the more aggressive they sold off. The brighter the green they are, the more aggressive they ran higher. And so it's fairly rare to get these types of sell-offs in key stocks. A lot of times when we're looking at this particular view, it's a little bit more cloudy or muddy. More of our squares kind of look more like, like what you see here with Procter & Gamble as an example. It was a sell-off day for Procter, but 1.6%, not the end of the world. Notice how bright all of these squares and rectangles are here in the financials area. These were some massive sell-offs that we had today. JP Morgan was down almost 4%. Bank of America was down almost 4%. Wells Fargo was down almost 6%. PNC Bank was down 6%. Truist Financial, a recent merger reorganization there, down over 6%. Fifth Third down 7%. Regions Financial down 8%. KeyCorp down 8%. These are some huge numbers. Even Schwab. Right? Many of you use Schwab probably. If you didn't use them before, you might very well use them a bit more now if you were part of TD Ameritrade previously, like David and I were. Of course, we worked for the company, so a little bit more familiar with TD Ameritrade's resources there, but most of you are aware that Schwab bought out TD Ameritrade along the way. And so even that stock got hammered today. It was down almost 8% in one single day. The reason behind that is because interest rates fell. For the most part, that was the reason. There's maybe one-off stories there as well. You did see American Express as an example down 8% there. And for the most part, you didn't really see much in the way of positivity in the financials. I did see that S&P Global, which is the company that licenses the S&P name to ETFs and fund families and different things like that. They're also a bond rating agency. They were up nicely today, about 4% there, but that was more of a unique circumstance with an earnings and a dividend announcement in that case. That stock is actually a dividend aristocrat. We don't talk about it a lot because it has a really tiny yield, but technically it has raised its dividends for more than 25 years in a row. But other than S&P Global and FactSet, those are the only two green rectangles or squares that I see in this financials area. Every single one of the other financials was down, and not just down, but in many cases down substantially, like 8% moves. And again, a big reason behind that, we'll talk about it a little bit later when we get into our 12 grid analysis, is falling interest rates. Treasuries benefited from a kind of a flight to safety status. And of course, when Treasury bonds are purchased, their interest rates or their yields go lower. And that was what we experienced here today. So I would say that was one of the major stories of today's price action. Now, beyond that, you can see we also had a healthy amount of selling in more of these tech-oriented areas, Remember when I was with you last on Thursday, we actually had a pretty positive day. It was more of a risk-on type of a day there when markets were rallying furiously. Well, just like that, we're back in that give-back mode. What I referenced a week or two ago as selling the rips, right? We are still in an intermediate downtrend. Despite how good Thursday and Friday may have felt to bulls, we are not out of this skirmish yet. We still have a lot of work to do on the charts, and we'll get into that. But it is a reminder of why we say things like sell the rips, because you might have had an opportunity to sell some of those stocks that you kind of felt buried in on Thursday and Friday while the getting was good. And now as we kind of start off things here this week once again, we're back to that more bearish sentiment and sell first, ask questions later type of a mindset. A reminder, by the way, David's on vacation this week. I believe he'll be back on Friday, if I heard him correctly. So that's why there was no market outlook yesterday. He's usually in charge of doing it Monday, Wednesday, Friday. So there wasn't one yesterday. There won't be one tomorrow on Wednesday. But since it's Tuesday, I'm doing it here today, and I'll do it again on Thursday. And then I believe he'll be back to do it again on Friday, as long as he makes it back from his vacation in one piece. Anyway, back to the heat map here. You'll notice that there were a handful of other areas in green today, but those areas were mostly in the energy area. So note down below, kind of in the lower right-hand area, stocks like Chevron, which is a dividend aristocrat, up 4% here today. Exxon is also a dividend aristocrat, up nearly 1% today. And then other kind of smaller energy players like Occidental, up 7%, Conoco, up 2%. It was kind of interesting, a lot of the independent refiners and even some of the oil field services companies didn't really participate. So notice that Marathon Petroleum, Phillips 66, and Valero, those are all of your independent refining companies. They actually all finished in the red. Now keep in mind that they make money off of selling refined product. They're not always out there as the exploration and production unit. So sometimes they actually have to buy barrels of oil off the open market. And when barrels of oil get really expensive, they can't always make that up off of their so-called crack spread. So that could be playing a role with the difference between the refining companies today versus the exploration, production, and kind of vertically integrated companies. Schlumberger and Halliburton both sold off today here as well. So a little bit of a mixed day there in energy, but that was one of the other big stories and has been a continued story for all of 2022, which is basically surging oil prices. And again, we'll take a look at that once we get to the 12 grid a little bit later, but it's been interesting to put it mildly. You also saw a handful of other green squares pop up here and there, sometimes as a result of individual earnings stories. For instance, Target, yet another dividend aristocrat there, was up nearly 10% here today. That one I have mixed feelings over. Well, a number of you may own it from the days when we've purchased it in my dividend classes over the years, since it never has cut its dividend, so many of you shouldn't have ever sold it if you practice those particular rules. Why it's a little bit disturbing for me at this moment in time is we were actually trend trading it in a different one of my classes, not a dividend class, but a trend trading class, and we recently took ourselves out of that trade because it was breaking trend, and wouldn't you know, reports earnings today and blasts higher. You're not going to win them all. Unfortunately, we had to let that one go, but good for those of you that are dividend growth investors that hung on to that aristocrat there. A nice 10% move for you there today. Home Depot, you'll recall that we sold a put on Home Depot a week ago in this presentation after it had plunged on its own earnings announcement, and we sold a put at a strike price that we perceived to be an attractive yield zone. So it was nice to see it stabilize today while the rest of the stock market was really crumbling around it. So Home Depot up 1.4% today. You did see Lockheed Martin and Northrop Grumman also up about 5% and 3% respectively, and that should be for obvious reasons, right? If we're concerned about the Ukraine-Russia situation and possible war and what that means for the allies and what it means for ammunition and tanks and artillery and all that kind of stuff, sometimes you do have those defense contractors that benefit in that type of an environment, and that's where we found ourselves here today. So as you can see, it was tough to find the positive in the market today. A little bit here with the energy, a little bit in some of those defense contractors, and then maybe a little bit in retailing with Target, Walmart, Costco all up just a touch, and Kroger you could throw in there as well. All right, let's go ahead and pop on over now to our main part of our platform, where we can get a general sense of market breadth today. So what I've done here is I've pulled up the Market Watch tab on Thinkorswim, and then I'm using that visualize area up there as a sub-tab, and I'm using what's known as the Index Watch, and I've pulled up the public S&P 500 watch list. This gives us a sense of how the advancers and decliners were doing on any one given day. And as you can see here today, it was overwhelmingly towards the bears today. So only 95 stocks in the S&P 500 closed higher today, which represents approximately 19 or 20% or whatever it is. And so not a whole lot of companies managed to eke by today in the green. The vast majority of stocks across the board did finish in the red. And again, that's another sign that market conditions are not ideal for bullish trading at this exact moment in time. Let's pop on over here to the charts now. And wanted to bring up this chart 6D, as I typically do when we have at least a move of 1%. And while I had originally had that policy last year, when it was somewhat rare for us to get 1% days, maybe once every 3 weeks or so. Well, more recently, it's felt more like that's the normal course of action, not the abnormal course of action. In other words, we are almost always getting at least 1% moves, either up or down here, since basically the beginning of December, right? If you were to kind of look at this area where my mouse is here, kind of off towards the right, I'm kind of circling it right here. Right there is around Thanksgiving of 2021. Notice the size of the green and red bars to the right from that moment in Thanksgiving of last year, and you'll notice that it is decidedly different than what you see to the left of that area. In other words, prior to Thanksgiving of last year, we had a reasonably calm market. Yeah, you had some spikes here and there every so often, but it was not nearly as consistent as what you're seeing here. Remember, these blue bands right here represent the 1% movement areas. So when you have the green bars that are going up to this blue band on top, it means that that is at least a 1% move, or at least that's where the close was. Remember, this doesn't show you anything about intraday activity, but it does show you where was the close, and was that close more than 1% up? Or in the other case, if you look at the red bars down below and they cross below this blue line, that means those are days when the S&P 500 closed down by at least 1%. And notice how many of these red bars, since going back here to November 26, when we had this really big 2% down day, right, came down here to this orange line, not just the blue line, but it advanced even further as a 2% sell-off to that orange line. But if you were just to look at the red bars and then kind of look at that blue line back behind it, notice how many 1% sell-off days that we've had. I mean, it seems like more than half of the days when the market was down, it was down at least 1%. And it's not just that it's one-way train down. We also have snapback rallies that are a little bit more violent and vicious to the upside as well. That's what those green bars being so tall up above are telling us. The problem is this doesn't feel like an equal market. In other words, when you get one spike down in the red, you get an equal spike back up in the green. It kind of feels like this is a market where it's 2 steps backwards, 1 step forward. And so it's kind of a losing battle at this moment for the bulls. And this chart up above will show you the actual price candles of the S&P 500. Again, kind of going back here to November of last year. Remember, the S&P 500 after November 26, or right around Thanksgiving there, actually did end up advancing to new all-time highs here to begin this year. It's kind of crazy to think that today is March 1st, which, by the way, today was a down day. Remember, more times than not, the first trading day of the month is an up day, but today proved that it's not going to happen every single time. But anyway, we're only 2 months into this year. A lot of people certainly don't feel like the S&P 500 was literally hitting all-time highs this calendar year 2 months ago on this day right here on January 4th. For a lot of people, it probably feels like many, many months ago since we had an all-time high, but it really wasn't. It was just simply 2 months ago. That's it. Not quite even 2 months if we were to use the calendar. So anyway, after Thanksgiving, when it started giving us these kind of herky-jerky movements and we started getting more volatility, you actually did have, one more rally higher there by a lot of those FANG stocks. Remember, the S&P 500 is market cap driven, so that kind of impacts things a bit more than what you might suspect. But the NASDAQ did not. Remember that the NASDAQ actually topped out back in November and never did hit a new high. If we were to just pull up something like the QQQ to get a basic understanding of that, notice that the QQQ, which is the ETF that tracks the NASDAQ 100, topped out on November 22nd. And although it had a rally attempt into the end of the year, it wasn't able to quite get up and over that prior high there. So it has been a bit longer. It's been more like 3 or 4 months since we've had all-time highs in the NASDAQ. So with a lot of people getting hurt in their growth stocks, this probably feels like the more accurate sentiment of the day as opposed to the S&P 500, which did just hit an all-time high here. Earlier this year. So anyway, S&P 500 once again a big down day and has been a continued theme of what we've seen so regularly in calendar year 2022. It's felt a lot different than calendar year 2021, and I would not anticipate that changing anytime soon. We still have a lot to deal with from a news perspective. We're still dealing with Russia-Ukraine. We're still dealing with the possibility of the Fed hikes down the line. We're still dealing with inflationary pressures and supply chain and all these other types of things that are concerning the market at this moment in time. You will notice, by the way, down below, as is often the case, when the S&P 500 falls, especially when it falls a larger percentage like it did today, it was down 1.55%, the VIX goes up. So the VIX is this purple line that you see down below, and it is basically at 33 at this moment in time. So remember last week I was telling you in this presentation that I think it was Thursday in the morning the VIX got to 38. By the afternoon when the market rallied, the VIX fell all the way back down to 30. Well, here we are just a couple of trading days later, we're back up to 33, and you can see where that is in relationship to where the VIX typically is. In other words, we are at one of the higher levels over the past year for volatility. The only other major time that it was obviously higher than where it is right now was just a week or so ago on February 23rd. Otherwise, where we're at right now effectively matches where we were at the end of January, and every other spike that you had in the VIX prior to that was lower than where we're at right now. So in other words, we are in a higher volatility market at this moment in time. Interestingly enough, we are actually at an equal volatility as where we were back at the end of January, even though we're slightly higher than those intraday lows at this moment in time. So in other words, it feels to me like the market is equally as concerned today as they were back then. In fact, probably a little bit more concerned today than they were back in January, even though prices in late January were slightly lower than what we see right now. So, the fears haven't gone away. And when we're in this type of a market, I enjoy being a put seller, and we'll talk about that a little bit later in our trade application example, but I've already kind of alluded to that in this presentation when I was referencing Home Depot, right? That stock that was getting annihilated last week was up today. I like to kind of sell into that fear because it gives me an added bonus of getting juicier premiums than I probably deserve if I'm doing it on the days when the stock market is selling off and the VIX is up. And that did represent what we were experiencing to a large degree here today. Let's go ahead and take a look at our more traditional foregrid now and get a sense of how things look from an index perspective. And as you can see, we did have sell-offs across the board today, and we do have weekly bullish postures. That's what that light green background color suggests in the background of all four of those charts over the current candle. But I will reiterate something that I reiterated to you previously, and I think it was kind of back during this time period over here in early February, when we also briefly had weekly bullish posture, is that I personally don't trust it a lot right now. And the reason for that is we have downtrending 30-day moving averages across the board as well. In fact, prices below downtrending moving averages in all four of these charts. With the Russell 2000, it's been more impressive here recently. And remember, we'll talk about that a bit more tomorrow morning in my factor-based swing trading class when we talk about the low size factor. But I will say that it has impressed me a bit more in recent weeks, and I hope that that's been fairly obvious for those of you that have listened to me over those weeks, because it does have a different feel than what I felt about the Russell 2000 back here in late December and into the middle of January. There it was very much an underperformer, but it is starting to actually be a little bit more resilient. Whether it lasts or not is anybody's guess. What makes it a little bit strange is that they were the one that did hit the 52-week low here just a week ago. And I was mentioning at that time that the Russell 2000 was a lot different than these other ones, because these other ones were still higher than where they were a year ago. But the Russell 2000 really didn't have the rallies throughout last summer the way that the others did. So it was closer to its previous low, and therefore it was easier for it to kind of breach that low. But what I get the sense of here in the short term or in the near term is that there is more stabilization out of the Russell 2000 than what I am noticing out of a lot of these other indices there. So we'll see if there's anything that comes from that. Right now, you still have to trust that the trend is down. But if we woke up a month from right now and saw that the Russell 2000 was starting to take a little bit of a leadership role, it wouldn't be entirely surprising at the same time, given the resilience I've seen out of this here in the last couple of weeks. Remember, just yesterday, it was above its falling 30-day moving average. That's why that moving average was yellow yesterday. Notice that that is not the case with the other three charts. The other three charts have had a red moving average for weeks, if not months. Heck, with the NASDAQ, this is really brutal. NASDAQ hasn't had a different color on the moving average other than red since going all the way back here to January 4th. So we're basically 2 months straight of a red moving average. A reminder for those of you that are new, that moving average is a 30-day moving average, and it is red when price is below it when it itself is falling. So in other words, that is a clear and consistent downtrend that the NASDAQ has been in for the last 2 months. With the others, you've had a couple of, touch and go moments where it made you wonder if there was some stabilization, but then it proved to be a non-event. So, for instance, you did have one day over here on the Dow Jones back on February 9th where it looked like it was gathering some steam and then immediately just rolled over the very next day. So you had a couple of those yellow patches that broke up the red along the way on the Dow and the S&P 500. So the NASDAQ has been most consistently bearish over the last 2 months. The one that I'm getting a little bit rosier feeling towards right now is that Russell 2000. But obviously, I'm not going to get ambitious and bold towards that because I want to respect trend. And right now, trend is still suggesting further downside action. But eventually, a trend has to change, right? And so that's what you're questioning. When will that trend change? And what will we see when that occurs? Well, naturally, if you want the 30-day moving average to start turning around from going lower to eventually flattening out to eventually going higher, then you're going to want the price candles of the security itself to start trading above the moving average. And at least we got a hint of that yesterday with the Russell 2000, even though it gave it right back here today. Whereas we couldn't make the claim on the others. So let's put a pin in the Russell 2000 there, and let's see how it can perform moving forward. But there is a chance that it could assume a leadership role moving forward based upon the resilience and the stability I've seen out of it in the last couple of weeks, where I haven't really witnessed that to a large degree with most of the other indices. So, to put a ribbon on it, all four of these major U.S. equity indices do have weekly bullish intermediate postures according to the market forecast technical indicator, but I, for one, am not overly trusting towards that posture at this moment in time because I also recognize that the moving averages are still pointing lower in all of these cases, and you might have a situation where the path of least resistance is to the downside, where you get these little brief pops here and there to the upside upside along the way to kind of cool things off, but the confirmed trend at this point remains to the downside. So this is still a cautionary environment that we're operating within. In terms of the percentage movements of each of these charts here today, we did have the S&P 500, as mentioned before, down 1.55%. The Dow Jones was down 1.76%. Now, keep in mind that we ran into a period of time here, kind of in this maybe January time period, where the Dow was actually an outperformer. And the main reason there was because you had a lot of the oil companies, financial companies, and consumer staples companies like Procter & Gamble and Coca-Cola. Oil companies like Chevron benefited it because oil prices were going up. The big financial companies like Goldman and JP Morgan and those types of companies were at an advantage because interest rates were going up. And then you had Procter & Gamble and Coca-Cola, Walmart, those types of companies in the staples area doing reasonably well because there was a flight to safety type of a mindset there. What has changed since then is not necessarily oil prices, so we know that Chevron is still doing well, but the major change is what's happening with the financials. And again, we'll talk about that in a little bit, but we did see interest rates fall pretty considerably here today, and that really hurt the financials, and therefore, stocks like Goldman and JP Morgan and the like really struggled. So it was kind of interesting today to see the Dow Jones on a down day being one of the bigger underperformers. It underperformed the S&P 500, and it also underperformed the NASDAQ composite. Remember, all else being equal, you get kind of more alpha out of the NASDAQ composite. So when you have a general up day for the market, all else being equal, you assume the NASDAQ goes up a bit more than average. When you have a down day for the market at large, you assume that the NASDAQ goes down more. There's more juice in those types of names compared to something like the stodgy Dow Jones Industrial Average. So I think it is worth noting that the Dow did underperform today, and I think the key reason behind that was what was happening there with the financials today. So NASDAQ was down 1.59%, and then the Russell 2000 was down 1.93%. Let's step away from the platform and pop on over to the internet briefly. I always like to get a chance to say thank you to those of you that help support this presentation. Remember, it is free. It takes 3 hours out of our day to do the videos. We don't charge you to listen to them or anything like that. We post them on YouTube for free. We hope that they are useful and valuable to you. And our hope is that if they are, that you'll help support them. And the one way you can say thanks for doing these videos and taking the time out of our busy days to do them for you is by clicking like for us on Twitter. As long as I'm getting up and over 100 likes, I'm willing to do the full-length video, which would be a half an hour or more. Some cases we've been doing hour videos lately because there's been so much to talk about. If we get under 100 likes, then we'll only do a 15-minute quick hitter type of a video. So I'll let you guys kind of decide collectively. If you like these longer form videos that include a trade application example, then you'll want to click like for us on Twitter. If you would prefer no trade application example and just quickly review the indices for 15 minutes, then don't click like, and then we'll kind of determine that. So, I'll check it on Thursday before we're planning to go and do some prep work and look for a trade application example. So we'd want to get up and over 100 likes by Thursday, at least an hour before the market is going to close. That way it gives me at least an hour to look for a trade idea for you guys if I know that I have to do that. So anyway, thank you to the 102 of you that helped us along with that the last time I did the video on Thursday, and that's the reason we're doing a full-length video for you here at this moment in time. Earlier today, I did teach my dividend growth investing class. Now remember, yesterday I taught my top-down trend trading class, and I also taught my options for long-term investors class. So on a day like yesterday where David is on vacation, remember I'm still working. And so for those of you that were looking for investor education, that's the benefit of having a premium or a plus membership with Market Scholars, is even though David wasn't able to do the free YouTube video for you last night, I was still doing my premium content classes, 2 of them as a matter of fact, Connect yesterday afternoon, where you can have lots of good discussions about what's happening in the market and how to trade it. So earlier today in the dividend growth investing class, we did cover the communication services sector. We had an excellent discussion about some of the available choices in that group that are starting to become a little bit more attractive after this recent market sell-off. So feel free to watch that recording. It has been posted to our Trading Rooms calendar up above. Tomorrow morning, I'll be back in action for my premium members at 11 a.m. Eastern Time with factor-based swing trading. So again, we'll be talking about the low size factor, we'll be talking about dividend yields, we'll be talking about value factor, momentum, and all that kind of good stuff. So feel free to join me tomorrow for that. Again, David will not be doing his normal classes or the market outlook video tomorrow. So if you're looking for educational content, feel free to swing by my class in the morning at 11 a.m. Eastern Time. I'll look forward to seeing many of you there. I also see that some of our newer students, remember last week we ran our 22222 sale, if I could spit that out the right way. So we did have a number of new folks joining us, and we really appreciate that on a premium side of our business. And I can see you've been busy taking advantage of some of our additional resources over here, including our Trading Rooms registration. Remember, that has been updated. David sent out the email to all of our premium members on Saturday to let you know that you can register for all of our March classes at one time there. So that's a benefit of you premium members. And it looks like some of you are also taking advantage of my drip tracker spreadsheet and tutorial. This recent popular post or whatever it is over here basically is automatically just showing you what other people are clicking on. So I can kind of see, what you guys are collectively clicking on. And it looks like some of you who are newer to our program are probably interested in dividends like I am and are interested in my drip tracker spreadsheet that I provide for all of my premium members there as well. Let's talk about the sector selector. Remember, I post this to our website on Friday evenings, and so it is a couple of days stale. I always like to point that out, but it at least gives us a general sense of rotations that might take place here more recently. And remember, this is an equal weighted approach is how I'm ranking this, and I'm using multiple time periods with a weighted emphasis on the more recent time periods like 1 month as opposed to further back like 6 months. So anyway, the sector selector, as you can see, has the same king up at the top, and that is energy, and it's not particularly close. Energy has been number one since the first week of January and has remained number one every single week since then. In fact, one of the things I posted to Twitter here a couple of days ago that some of you might have seen was that every single energy stock in the S&P 500 is higher in the year 2022, which is pretty darn impressive. There's not a single exception to that, or at least there wasn't a couple of days ago when I posted it. So again, every single oil and gas stock in the S&P 500 is higher in 2022 when most people feel like you couldn't possibly find anything that's bullish out there, right? That's the way a lot of people feel because it has been brutal in so many other areas. But as long as you have some energy exposure, you are at least having a portion of your portfolio doing well while the rest of it is struggling, and that offset is useful for a lot of folks. One of the things I do teach to in my dividend growth investing class specifically is diversification. And of course, we do have plenty of exposure to oil stocks from our previous dividend growth investing portfolios over the years. So I imagine a number of you probably own Chevron or Exxon or Phillips 66, those types of companies. And if you do, well, at least those companies are up this calendar year. As for the rest of the sectors, not nearly as exciting. You do have some strength in consumer staples and financials from that perspective, but most other sectors have way more than half of their components in the red so far in 2022. So it has not been kind, it has not been easy to operate or navigate if you're on the long side of the market. But again, energy remains number one. One thing I should point out, and we spent a lot of time in Monday's class, yesterday morning's class, with the top-down trend trading group, with materials. Now, materials is a little bit more wide-ranging sector compared to energy. Energy, pretty much everything revolves around oil. Sure, you've got your refiners versus your vertically integrateds versus your exploration and production and versus your services company. So there's some little differentiations there. But within materials, it's a much wider gamut there that you have. You have things like industrial gases companies that are doing somewhat poorly at this moment in time. You have things like steel companies that are absolutely roaring higher. You have gold companies that are impacted by geopolitical events that have performed quite well here more recently. You have salt companies, you have lithium companies that benefit from electric batteries. So there's a lot more kind of diversity, I guess you could say, within materials. It's not quite as consistent as what you see in the energy sector. So having said that, the metals and mining area specifically within materials is very robust right now. There are a ton of charts in the steel, copper, iron ore, gold, aluminum. That type of an area is red hot right now. So if it wasn't for some of the other areas like lithium and air products or industrial gases, I should say, within materials, you'd probably find materials up there neck and neck with energy. But there's a couple of areas that are holding materials back, but don't fall asleep on them. There's some great looking metals and mining charts out there at this moment in time as well. All right, let's get back on track with some more charting analysis over on the Thinkorswim platform. And we're going to pull up chart 5A to get this conversation started with, which is our asset class 12 grid. And a reminder that the background colors of these charts will change according to whatever the current posture is. So if the current posture is bullish, then those charts will be green. If the current posture is bearish, then those charts will be pink. So let's start with the big story of the day, which is down in the lower right-hand corner. Interest rates have absolutely fallen off the map in the last couple of days. You'll notice that it wasn't too long ago, maybe just 2 weeks ago, we were talking about how interest rates just knew no bounds to the upside, right? That they wouldn't stop. They just kept on plodding along higher and higher and higher rates with expectations of, 6, 7, 8 possible interest rate hikes by the Fed later this year. Things have cooled off dramatically here recently, and part of the reason behind that might be what we're seeing with Russia, Ukraine. Remember, a lot of money is starting to flood into areas where it perceives safety, and sometimes when that happens, money starts flooding into U.S. government bonds, and when bond prices go up, interest rates go down and vice versa. So I think that's a big part of it. Another part of it might be the market's expectations about how aggressive the Fed will be if there is a global slowdown as a result of the geopolitical concerns we're seeing overseas. Remember, because Russia is the number 3 energy producer on the planet, if we shut them out from the rest of the global economy, we could have some unintended consequences. And the market's kind of grappling with that right now. And obviously, our hearts go out to those in the Ukraine, or in Ukraine, I should say. You guys are winning the hearts of the rest of the world, and we are there with you in spirit, without a doubt. But what it means for us economically is if the whole world turns against Russia and basically shuts it off from various financial connections, stops allowing Russia to sell other countries oil and gas, is that all of those countries, particularly those in Europe, it doesn't affect us in the United States quite as much, but particularly over in Europe where they have a cozier relationship with Russia in terms of gathering energy, you could see some industries starting to grind to a halt in the short term as they need to pivot to other energy resources. So the market's trying to account for that and try to determine, does the Fed actually want to be really aggressive right now like it had intended to be prior to Russia, Ukraine, or will they kind of tap on the brakes on that aggression a little bit and kind of ease their way into hikes. And that's kind of what the market is trying to determine right now by sending rates a little bit lower and treasuries themselves higher. This one kind of annoys me. As you guys know, I took an ambitious bullish trade on TLT a month or so ago with the hopes that all of these oversold cluster signals would result in an eventual bounce, dead cat bounce type of a rally. And then as soon as the February expiration cycle hit, that Friday, TLT was just barely below our short strike price, which I think was 139. I think TLT was at like 138.30 or something like that day. So it's kind of frustrating because I had to shut that particular trade down at a loss. And you can see now, had I just chose a different strike price or perhaps a different month, I would have been perfectly fine with that trade, because TLT, just like that, with the snap of a fingers, is way back above 141 again. And you'll notice today was an important day for TLT. Not only did you get the snapback rally that we were waiting for, but it kept going. We are now up and over that moving average, that 30-day moving average on TLT. Whether it stays there or not is anybody's guess, but this was such a big day. Remember, this is a 1% update, so that's a big day for the U.S. government bonds. And because that was such a big surge up and over, I think there's a greater chance that you could start building upon that. And again, if the market remains concerned in the short term, money can flow over into U.S. government bonds. And so there may be some opportunities there in TLT for the very first time in quite some time. You can see that we are above that moving average. Other big moves today. Let's talk about Bitcoin here briefly. Bitcoin has been really interesting to watch. You guys have seen me tweeting about Bitcoin here in the last few days, and in particular referencing Russian oligarchs, because it is my belief that Russian oligarchs are getting a massive wake-up call, because it realizes that they live in the wrong country and the world has turned against Russia at this moment in time and is refusing business, and in a lot of cases refusing financial transactions from taking place. And so Russian oligarchs, I have no doubt in my mind, are looking for alternative ways to get their capital out of the country. And so one of those ways to kind of cloak who you are and what you're doing is, of course, through Bitcoin. That's kind of the point of it to a large degree. And so Bitcoin prices have been absolutely flying here in the past week. It wasn't too long ago when Bitcoin, I think just last week or 2 weeks ago, was down at like, I think 37,000. And right here today, we are back up to 44,000. In fact, I was showing a chart on Twitter of Bitcoin priced in Russian rubles, and it was up 40% in a single week. So some really interesting price action taking place there as a result of this very unique circumstance where money is highly, highly concerned over in Russia, and trying to figure out a way to get that out, I think, benefits Bitcoin. So you can see we now have a strongly bullish posture on Bitcoin. In fact, you have a green moving average on Bitcoin for the first time in over 3 months. Notice that prior to this had been a red line and then a yellow line for a while, but this is the first time, the last 2 days, where we are back to a green moving average. And again, what that signifies is now price is above a rising moving average. It's hard to see that with the naked eye, but that's how the algorithm has been written for the think scripts there. So it is true that Bitcoin's 30-day moving average has just barely turned higher, and now price is above it as well. So who knows? Maybe we can build upon this. Maybe we do see Bitcoin prices back at $60,000 here in coming months if we still have further clampdowns on Russia and that money is trying to flee the country. Also, big movements here today in commodities. Notice that gold had a heck of a day. Gold was up 1.82%. We talked about gold back here last week and having this really peculiar candle where it had this massive gap up and then a sell-off for the rest of the day. Well, I, for one, would have been surprised had you told me on that day that we would have almost made up that entire move just 3 days later. And that is effectively what has happened. We're not quite to the intraday highs of where we were on February 24th for GLD, but we are right there, and it could happen in a heartbeat depending upon circumstances. Right? And a lot of this is driven by geopolitical concerns. Gold benefits as a safe haven type of an asset when that happens. In fact, we are trend trading gold right now in my top-down trend trading class. So this move today was beneficial towards us in that particular class where it's been more difficult to find individual stocks to trend trade. Well, there are commodities that are starting to look like good trends out there. So while gold does continue to have that weekly bearish intermediate posture because the intermediate line is at 79 and falling, remember, if it were at 80.25 and falling, this would be considered bullish still because it would be in the upper reversal zone, which is at 80 itself. But it just barely fell below 80 here, and so it still has to have that weekly bearish posture. But if we get another day like we experienced today, tomorrow or the next day, this will change back to strongly bullish posture very quickly. All it has to do is get back above 80, which is not very far away. So this is a great looking trend, and I very much expect its posture to flip back to bullish here in the short term. Let's take a look at oil now. Oil had a massive day, again, driven by Russia news and Ukraine news, with Russia being such an important oil producer out there. There's fears that the supply of energy that Russia supplied the rest of the world is now being cut off. And if that's the case, then prices need to adjust higher to make up for that lack of supply when we still have the same types of demands for the rest of the developed world. So oil prices responding positively to that news. While we're not trend trading USO in my top-down trend trading class, I did present that to my trend traders in a class here in the last couple of months. We ultimately voted for a different security, but just to kind of prove the point that you don't necessarily need to have stocks to trend trade. You can find other areas when stocks aren't working. You can find commodities, or maybe you will find currencies, or maybe you'll find that fixed income is trending. The point is there's always a bull market somewhere, and right now there's a bull market in commodities. Oil prices surging over 6% here today. Clearly a new multi-month, if not multi-year high, and we do have a strongly bullish posture, prices above a rising 30-day moving average. We also have the US dollar making a big move today in the lower left-hand corner here. That's UUP that we're using for that as our proxy. It gives us a general sense as to whether money is flowing into the US dollar or out of it. And right now, similar to why money is flowing into long-term US government bonds, money is also flowing into US currency because it is viewed as a safe haven compared to other currencies across the globe. When the Russian ruble collapses 30% in a single day, you'll see why we should be very thankful, at least those of us that live here in the United States, to have a currency that is reasonably stable. And that is what we experience. In fact, we're getting the benefit of fear elsewhere coming in and bolstering our currency here in the United States. Up on top, you'll see sell-offs across the board with other markets, including foreign developed markets. We're down over 2% here today. Remember, that's where you're going to get a lot of your Western European nations, which would have been impacted by the Russia-Ukraine news here earlier. And then we also have the emerging market stocks where Russia itself belongs. And we talked about this on Thursday, but just to kind of reiterate it, just because it is fascinating to watch from the sidelines. Thank goodness I don't have a horse in this particular race, because I'm pretty sure I'd be, I'd have a sore stomach. I would want to pull the car over and throw up on the side of the road. That's how bad this RSX chart looks. I was actually tweeting about this over the weekend, and at that time, RSX was only 51 cents away from hitting its new multi-decade low, which would take it below where it was trading in the great financial crisis of 08-09. With the last couple of days worth of trading here, we are now way below that. And so we are at multi-decade lows in the Russian stock market, and it happened in a heartbeat. I mean, this happened in basically 2 weeks. This thing was just massacred. You can see that this red label off to the right-hand side here says minus 71% in it. What that means is it's down 71%. in 3 months. So again, a reason I'm thankful to live in the United States with our deep and wide pool of capital and potential investment candidates here. It's not that we don't have our own problems. We've got plenty of them. But I am very thankful not to wake up to the fact that, let's say the S&P 500 was down 70% in 3 months. Can you imagine the chaos that would be happening in the United States? I mean, it would be pandemonium. So, it has been very fascinating to watch what's happened to some of those emerging markets, particularly those directly impacted by the war that has broken out like Russia there. All right, let's go ahead and take a look now at our sector analysis, and that'll be chart 5C for those of you that are following along at home. And as you can see, there's one chart that stands out for the good and one chart that stands out for the bad. The one chart that stands out for the good is off to the right-hand side here. It has that dark green background color, and by hopefully nobody's surprise, that is energy. Unless you've been living under a rock or have not been listening to these presentations for the last 2 months, you'll know that energy has been the leader and continues to be the leader of this market. So oil prices spiking today helped a lot of those big energy companies continue to go higher and higher and higher. And this is another one of those ETFs that we're trend trading in my Monday class that we are thankful for there. But remember, XLE specifically is going to be driven a bit more by Chevron and Exxon, because it is market cap weighted. And so fortunately, those two were up today. Remember what I was mentioning to you before, a lot of the independent refining companies were actually lower today. Even some of the oil field services companies were lower today. But you're not really picking up on that when you look at XLE because of the importance of Chevron and Exxon. They are by far and away the most important components within XLE. So when Exxon and Chevron are doing well, you'll likely see that XLE will do well and vice versa as well. So right now, a wonderful bounce up and off of that rising 30-day moving average there for XLE. We are at new multi-month, in fact, probably multi-year highs for XLE, and we do have that green moving average telling us prices above a rising moving average. So without a doubt, that is our strongest trending sector that's out there right now. On the flip side is the financials. And this one has been interesting because it wasn't so long ago, in fact, just here at the end of January, beginning of February, where there was some optimism rolling into financials. Now remember, that was in a different interest rate environment where interest rates were rising at that time. What we've seen since then is interest rates, particularly in the last week, have really rolled over. And remember what I've mentioned to you guys in this presentation and other classes countless times over the years. All else being equal, and it rarely is, admittedly, but all else being equal, when interest rates are rising, that benefits the financial sector and is at a disadvantage for utilities and REITs. The vice versa can also happen. When interest rates are falling, it much more negatively impacts the financials, and utilities and REITs do better on a relative basis. Now you'll notice that because today was an overall sell-off day, even the utilities and REITs were down today, but notice how different their results were compared to the financials. So utilities were only down 0.87% and real estate was barely down at all. It was only down 0.2%. So you'll notice that other than what we saw there with energy, those two were actually our best performers today. Admittedly, they were down, so it's not fun to talk about, but they were outperforming and down less than all of the other sectors. And the reason for that is that interest rate sensitivity, or at least I should say real estate was benefiting more from that. You could get away with saying that the staples and healthcare, other defensive areas, kind of match the utilities exposure. But real estate was the second best performer today, and I think a big reason behind that is because of interest rates that are falling. And the big reason behind financials being by far and away the worst performer today, notice how bad it was. They were down 3.69%. I mean, that is an epic candle that you see there on XLF. That is the worst looking candle on this entire 3-month chart here. And you can see that we're basically sitting right down there near or at 3-month lows all of a sudden. when it wasn't so long ago, when it looked like these things were going to break out to new multi-month highs. So that's how important the interest rate environment is to those financials, hugely important. You can see that they are now down over the last 3 months. Not a big amount. They're down 1.17%, but remember, we actually were viewing the financials as more favorable all the way up until just a week or two ago. And so they've given back a ton from their highs and are now negative over 3 months when they happen to be one of the few winners along with energy prior to this last week here. So that is quite unfortunate and disappointing. Now, when that happens, I ask myself, are babies being thrown out with the bathwater? And that's what I'm wondering today with one of my favorite banks. So let me get into our trade application example now. And let's start with chart 3A, which is the swing trading chart, because I wanted to show you one quick little feature here. And I'm pulling up ticker symbol JPM. This is JP Morgan, of course, one of the largest banks on the planet and a prominent institution here in the United States. And I wanted to first point out that the little green dot is appearing down below here. Notice that it did so back here on the 21st, and it also did so back here exactly 3 months ago on December 1st as well. So we now have 3 dots on the chart. And those dots represent when the market forecast lines of the blue, the red, and the green lines are all in the lower reversal zone on the same day. And so that was the case here. And what that is telling you is that this is a downtrending stock, which I think we can all recognize that with our eyes, clearly lower highs and lower lows. But what it's also telling you is that the selling has gotten so extreme that there's probably a decent chance at a reversion to the mean type of a move. Now remember, that doesn't necessarily have to mean that it's going to go from a downtrend into an uptrend. It basically just means in my head that we went down too quickly here in this most recent move, and that's unlikely to be repeated in the next week or two after that. So we could be on the lookout for some stabilization around these levels. And again, that's not a guarantee, but you try to use past instances of that to gauge whether this particular stock responds to oversold cluster signals or not. Back here on December 1st, when we had that signal, we did see the price action bounce in the coming week after that. With this other follow-up one that we got here on the 21st of January, we actually saw that that was an excellent time to be fading that sell-off. In other words, doing something bullish when you got the oversold cluster signal with the expectation of stabilization, and you actually had a really decent counter trend move there. Now that one has eventually failed, which has brought us to this one, where again, I'm wondering if this is a time where it starts to either go sideways or maybe meanders a bit higher again, as opposed to continuing to plunge now that we have an oversold cluster signal. Now, if I come over here to another chart, which is chart 2A, this is our dividend stair-step chart, ticker symbol JPM, you can see here what it looks like from a 10-year weekly perspective. And you'll notice that JP Morgan tends to be a good buy for the long-term investor when it has a dividend yield of 3.45%. At its lows today, it had a yield of 2.99%. In fact, it was just a hair away from having a 3% yield today. So it got 2.9999 effectively. And so in other words, the stock would have to fall further in order for it to get a yield of 3.45, right? When stock prices go lower, dividend yields go up and vice versa. So JP Morgan would have been an excellent buy back here when it was touching its blue line and in that blue zone back in 2020. And many of you probably picked up that excellent bank at that time. But let's say you didn't. Let's say you were a little bit nervous about the reopening of the economy after the coronavirus and all that kind of stuff, and you chose not to buy JP Morgan back then, and then you watched it rip all the way to new all-time highs within a year. At that point, you probably would have regretted your decision not to buy JP Morgan. So if that is your mindset, you've now watched this company go from 172 all the way down here to 136 in just a few months. And now that you're approaching that more logical place or rational place to pick up shares, even though you're not there yet, it opens up the possibility of selling a put. So again, I've been doing a lot of put sales in this presentation in recent weeks because the environment has been excellent for it. When the VIX spikes, I want to be bold and look for the highest quality merchandise out there where I perceive it to be a baby that could potentially be thrown out with the bathwater. And while JP Morgan's not at a buyable zone yet according to the average high yield theory, it's close enough where selling a put is now possible. So what I did, and remember I already sent out the telegram, this trade was done while the market was open today. In fact, I wanted to show you down below here that what we did was we sold the April $100 put, and if I click on the view trades here, it'll show me actually what time that trade got done, and it was 11:28 my time. Now that's mountain time, so it might be different for you, but the point is it was done 2.5 hours before the market closed here today. And the price I got was $1.04 for that, and we're already up $10. Now that doesn't sound like a lot, but remember in a percentage basis based on just one contract here, that's actually a 10% winner already on an intraday basis, as you can see right here under the PL area. And you'll notice that when I got filled at 11:28, that was approximately right here on the chart. So it did go a little bit lower in the next 10 or 20 minutes. And remember, I would have already sent out the telegram to all of you who were premium members by then. So some of you might have even got filled at a better price than 104. I saw some of them going off at $1.10 as an example. But by the end of the day, JP Morgan rallied into the close. And remember, that was different than the rest of the market. SPY actually sold off into the close. But JP Morgan rallied into the close and therefore supported our decision to get our trade done earlier. So I just wanted to highlight that because, again, that's a big advantage that those of you that are premium members receive. It's not that David and I are always going to be right with our trades, but the point is we let you know immediately when we're placing them so that way you can make the decision as to whether you want to also consider that trade for your own paper money accounts there as well. Because remember, everybody else who's watching this free video at night has to make the decision the next day. And if we get a gap up tomorrow, you're going to miss it at that price. I had the same conversation with you guys last week with Home Depot, and that ultimately ended up happening as well. So anyway, something to think about there. But JP Morgan, I think, is a very high quality bank. And if I could buy it down here at $100, that would be a dividend yield of 4% because they're paying a $1 quarterly dividend. So 1 times 4 is $4 divided by 100 is a 4% dividend yield. So I got 1% return on risk. So I took in $104 today to tell the marketplace that I'm willing to buy it at $100 in the middle of April if JP Morgan does fall below that level. Okay, so that's what I had for you just over the hour mark once again today because a lot of stuff to talk about. When the markets are aggressive and volatile, there's more things to sink our teeth into and learn from and educate ourselves from. So I hope you appreciate the extra time that goes into producing these videos. If you do, I have one simple request for you. Just click like for me on Twitter. As long as we're up and over 100 likes on Thursday, I'll plan to do another trade application like this JP Morgan one and do a full-length video as well. If we're under 100 likes, then I'll just do a brief 15-minute quick hitter video on the indices themselves. But remember, David's not with us this week simply because he's on vacation, so no video tomorrow, but I will be back with you on Thursday. So until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.